John, today's question comes from Brian, and it's about company stock and a 401k. So Brian actually has 3 questions here that's all related to this. First, he said, I know I can move company stock out of my 401k at retirement and only pay taxes on the basis. Can I move it before retirement, but after age 59 and a half without penalty? So let me hit the brakes for just a moment and explain what Brian is asking here with this whole thing about company stock and his 401k. So in some cases, you'll find people that have company stock in their 401k, and let's say that it's worth $100,000, but their basis in that stock is only $10,000, right? So what they put in was $10,000. What it's worth now is $100,000. So technically, there's a $90,000 gain there,
right?
But it's in their 401k, and ordinarily, anything that comes out of your 401k is taxed as ordinary income. So there's this rule called net unrealized appreciation that allows you to take that company stock, move it into a non-retirement account. So this would just be like a single joint account or something like that. And then you would pay ordinary income on the basis of that. So the amount that you contributed, you would pay ordinary income in the year that you distributed that. And then you would pay a capital gain on the remainder of that when you sold it.
Okay. Now, does this applies only to the stock of the company that you work for?
Yes.
Sort of thing, right? So if you worked for Enron and your 401k with Enron was loaded up with Enron stock,
yes,
and you got out early before Enron collapsed, then that's what you're talking about, right?
And you think about all the people that are working at NVIDIA right now, where I saw a report the other day that said the average employee is a millionaire now, right? Because they've got this NVIDIA stock. Well, a lot of them could use a strategy like this to pay a much more preferential tax rate of capital gains and have some control over when that's paid out too.
Right, absolutely.
As opposed to ordinary income. Because I think the capital gains rate for married filing jointly, that first threshold in 2025 is $96,000. It's somewhere in that range.
And that's before you get to the 20%.
Well, that's at the 0%.
Right.
Rate. And then it steps up to the 15, and it stays there for a long time, and then it bumps up to 20.
Right. Yeah.
So, if you're paying an average of 22% taxes on all of your other stuff, you could easily be paying 15 on your capital gain. Not a big deal, but it is something that you could use as a strategy to maybe move forward to another year where your income was low. Maybe you're taking distributions from your taxable account, where you're not going to really have a lot of taxable income. Then you could realize that capital gain and get a lot of that tax-free, right? So that's the whole net unrealized appreciation strategy. And he's asking, can you do that? Pay taxes on the basis before retirement, but after age 59 and a half without penalty. So the answer to that is yes, he should be able to. Now, the penalty part after age 59 and a half is not an issue. This could come down to the individual plan. There's still some old plan documents out there that say, hey, no, your triggering event is termination or death.
Right.
Most plans, though, will let you do what they call an in-service withdrawal at a certain age. So in most cases, if he has company stock, it's going to be a big company.
But the question related to the taxation of it does not change. It's just whether or not the company plan will allow it.
Yeah. So that's a bit of the unknown here, but the company should allow it because it's, again, if it's a company that has stock, it's probably a large company, and therefore they've got some up-to-date plan documents. His second question is, if I move it before retirement, can I move it in segments over the next 2 years to help minimize taxes? The answer to that is no. When you do this, it has to be a complete distribution from the account.
Okay.
So you can't do this in segments.
So all the company stock comes out.
That's right. Well, not only the company stock, but you can't just move the company stock. You have to move everything in the account.
Everything. So like in your example earlier where you have these NVIDIA millionaires, they would have to move the whole million out of the company plan.
Well, and let's say that you have that $100,000 in stock, and then you've got $900,000 in your various Fidelity mutual funds, the whole kit and caboodle has to go, right?
Okay.
You've got to do that rollover. Again, in most plans, that's not an issue. They'll let you do that after age 55 in most cases. Some say 59 and a half. There's still a few that say at retirement or death. But most likely, yes, he would be able to do this. The third question he asked is, if I can move it in segments, and he can't. So maybe we shouldn't even answer the third question, right? Can I move only some of the basis amount and leave the capital gain in my 401k and move it and the rest of the basis the next year? That's some good thinking. You know, John, this sounds like some questions that I would ask you, right?
It does.
I'm asking you questions like this pretty often. Well, can I do this? Oh, no. How about this and this and this?
Yes. This is one of those where if you thought of it, you certainly were not the first to think of it.
Right.
And if you weren't the first to think of it, the IRS and such,
they're ahead of you on this.
Or have probably thought of it before you did.
Absolutely. So they for sure want you to get all of this moved at one time. And here's the interesting thing on this. When you make this move, the basis is ordinary tax, ordinary income, right? The gain is always going to be taxed at a long-term capital gain. All right. Now, any growth from that day forward is going to have the normal treatment, right? So it's going to be short-term if that growth has been in there for less than 12 months, long-term on the growth that's been in there for over the year. So a typical capital gain, but only on the part that has grown.
Yeah.
Now, that can get confusing on a 1099, right? When let's say that you've moved your $100,000 worth of stock, you've paid ordinary income on the 10, now you've got 90 in a gain, and that 90 grows to 100. Well, now you sell that in, say, 11 months. You say, I'm getting out while the getting's good. That entire 100 that's there, that's grown from 90 to 100, that is not a short-term capital gain, but it could be confused for that. So if you've got company stock and you're doing the net unrealized appreciation, I've gotten lots of calls from clients that said, hey, this NUA thing we did, my CPA is saying that blah, 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 no, here's the rules. I'll send it to him.
Right.
So it is an area of confusion for sure.
Interesting.
Yes.
That was a good one.
It can be a big tax-saving move that you can make because a lot of people will often have a lot of company stock in their 401k. Perfect. Brian, I hope that answered your question. And to the rest of our listeners, bigpictureretirement.com, up in the top section, you'll see Ask a Question, and we'll cover it.
Yep. There we go.
If it's a good question.
If it's a good question. Or if it's just praise.
Yes.
We might cover those too.
Yeah. If it's a complaint, we may just hit the delete button.
It's possible.
Excellent. All right, everyone. Thanks so much for listening.